Episode 562, Trading Justice Podcast. I was about to say halftime report. Man, when I do programs with you, Matt, it's like, I barely knew it was a Sunday. I've been dived into the markets all weekend, because I ended the week confused, right? And confusion, there's nothing wrong with confusion, right? As long as you're not blindly acting on confusion. So it felt like a halftime report. But anyways, Matt, how are you doing? How did the Dolphins do this weekend?
They did great this weekend. We're looking forward to next year.
I'm such a troll. Anyways, Matt, all-time highs in the market. Only took it. Now here's my snarky comment to open up the show. Only took it 2 years to do it. I've been doing all-time on my highs constantly over the last year. So nice to see the S&P finally catch up. But all-time highs, right? It's going to catch the headlines. Reasons to be concerned, reasons to be cautious. We're going to break it all down on this. But how are you doing, Matt?
Doing good. Excited to be here for another edition of the podcast. And yeah, Mark, I think it's okay to be confused in the market when you have the S&P breaking out of an all-time high, you have yields climbing in that environment, and you have the dollar starting to trend to a certain extent. And so in an environment where dollar yields and the market are all up last week, that's not something we see every week. In fact, that's not something we see very often. And so in an environment where something is occurring that oftentimes does not occur, I think it's okay to question a little bit the veracity of this breakout in the market.
Yeah, I know. Thursday, because we had, and the big story last week was Taiwan Semiconductor earnings. And on Thursday, we had the market, had a couple days of softness. Taiwan comes out with their earnings report, gaps up tremendously, semiconductors and that, listen, you get a news story, and we'll break down that news story here in just 30 seconds. Sure, fine. Friday thoroughly confused me on market action. Thursday was just, hey, all right, yeah, green day after a couple red days. The ferocity of the move on Friday felt, I was like, what's behind this? And so, what I want to do at the start, because we're going to talk about the dollar a little bit kind of in our feature segment about the importance of the dollar and how it, when it trends strongly, how do equities perform over the last 15, 20 years? We're going to talk about that. We'll talk about the correlation to yields, but let's just talk about earnings to start the podcast.
Yeah.
Taiwan was the big news story. And on the halftime report, you were like, I guess, right? You were like, yeah, I mean, they're all right earnings. Is it the reason to you were like, obviously your body language, your words, your tone, everything were like, no. What were their earnings report?
Well, a couple things. Number one, and I'll get into the landscape of earnings season here in just 1 second, but a couple words just specifically towards Taiwan Semiconductor. It really was one of the catalyst events last week where, the market really wasn't doing much up until Thursday. And then after Thursday, after Taiwan Semiconductor reported their earnings report, it almost gave the market the reason that they were looking for to start pushing price back up to a certain extent. But to me, it was a little bit of and again, I don't want to come across as saying something negative towards Taiwan Semiconductor, because it's one of my favorite semiconductor companies. I've named it the most important semiconductor company in the world.
And explain that for a new listener. Was Taiwan Semiconductor a new trader? Like, what is Taiwan? I mean, why are they so important? Because they're not just for semiconductors; they're important for everything.
Yeah, you don't go directly and buy a chip from Taiwan Semiconductor. They're not the brand-facing company. Everybody's familiar with NVIDIA. For example, gamers have been on this.
I have an NVIDIA X insert card. Yes.
Yeah. And so AMD, NVIDIA, even Intel, right? Those three companies are the three companies that most people, like consumers, would reference when they talk about the semiconductors. But when you're talking about semiconductor companies like AMD and NVIDIA, the two AI companies that really kind of focus on GPUs, well, where do they get all their chips? They get them from Taiwan Semiconductor. Where does Apple get their chips? They get them from Taiwan Semiconductor. Where does Amazon get their chips to feed their AI development? They get theirs from NVIDIA, who gets theirs from Taiwan Semiconductor. You can't have a semiconductor conversation without including Taiwan Semiconductor in that. And so NVIDIA gets a lot of love. AMD gets a lot of love. But the gasoline behind AMD and NVIDIA is Taiwan Semiconductor. The gasoline behind Apple, Microsoft, Amazon, Taiwan Semiconductor. And so they're the biggest semiconductor company in the world. And they're the first semiconductor company in earnings season to report. It's kind of like the Schlumberger early report for the energy components. And so what happened on Thursday, Taiwan Semiconductor reports their earnings, and it's a Tackle 25 company. It's been a Tackle 25 company for 7-8 years now. And they came out with a decent report. They came out with 144 against 137. Revenue slightly topped the expectation. But where the market was centered on in the Taiwan Semiconductor conversation was on the forward-looking guidance. And basically what they said, I'm not going to go through it in great detail here, but basically what they said is that they should see a little bit of weakness in their semiconductor components for smartphones, but that will be offset with additional demand on their GPUs and basically the semiconductor, NVIDIA, AMD. And so their guidance reflected a slight bump up in revenue with a little bit of contraction on their smartphone chip segment, with a little bit of additional growth coming into the semiconductor specific segment. And so you had a slight bump up in forward-looking guidance. Mark, I report on earnings all the time. I cover a tremendous amount of earnings. The market heard something here that I didn't. I took it as a slight improvement from an earnings perspective on Taiwan Semiconductor. The market heard go. And I'm not sure that's what Taiwan was saying within their guidance. And until on Thursday, you were actually seeing a little bit of fade down before recovery on the back half. But then on Friday, you just saw this continuation. And so to talk about it, Taiwan was certainly a catalyst event because it propelled NVIDIA higher, it propelled the Max 7 higher, sans Tesla, it propelled communication higher, but did it propel the entire market higher? The answer is no. You did not see a major breakout in all areas of the market. You saw a breakout in the S&P 500 and specifically in the NASDAQ. And so in the marketplace, as represented by the equal weighted RSP ETF, you didn't see that type of market love here, Chuck. You didn't see the market firing off on all cylinders. You didn't see sectors firing off on all cylinders. You saw communications, you saw technology firing off on all cylinders. And it really reminded me a lot, and it's only 1.5 days in the market, but it really reminded me a lot of the 6-month saga last year, where it was all tech, it was all comms, it was all Mag 7, it was all aggressive, and everything else was basically flatlining or slightly down. And so the market in the first 6 months, if you'll remember, the market's up 10, 12%, technology's up 20, 25%, RSP, Russell 2000 just doing pretty much nothing. And so why is it that the S&P...
And really, Matt, it was the first 10 months because while tech
it was up until
the drawdown, it held up in the sell-off better. And, I brought that up in the halftime report on Thursday, Matt. I was like, today feels a lot like that. And, here on a Sunday, right? Yeah. What was the Major League say, how many does it take to make a streak?
Takes 3.
Takes 3. Well, it feels like we got 2. And that's certainly in the backdrop, because that wasn't, Matt, 2023 was somewhat tactically difficult just because you had to adjust to tech. Like you had to, and you had to be like, all right, that's the market we're in. I mean, that's why the question, and I don't have the answer, so I'm not, I don't have the answer, but
Okay, let me throw a tiny bit of cold water on this tech move.
I would love to,
Okay,
because
just
I don't want to
tiny
go
bit.
through that again.
Last year, when we were in this exact same time frame, it was in February, it wasn't in January, but it was in that same type of earnings conversation when you had the tech trade, and when the tech trade just started absolutely dominating everything, Mark. It wasn't at the very beginning of last year where you started to see tech really start to trend, really start to do good. It was after Nvidia reported its first quarter earnings, and they had that beautiful upward movement in price. They had that just astonishingly knockout guidance, Mark, where expectations were like 88 cents. And all of a sudden, we're talking about an EPS handle on Nvidia at like 488. It became such a compelling earnings saga as told through EPS beats against expectation and increasing forward-looking guidance. And that storyline propelled AI. That storyline propelled the tech trade. That storyline carried a lot of heavy water last year. That was on Nvidia, and one of the most outstanding, impressive guidance reports I've ever seen in the market from any component at any time in my career. That was
Matt, when I woke up.
Hold on, really quickly.
Oh, yeah.
This year, we're talking about that exact same scenario happening right now. We're talking about the tech trade. We're talking about the semiconductors. We're talking about Max 7. We're talking about the breadth of the market getting worse when it had been getting better and better and better. And what's it on the backs of right now? Well, obviously, it's on the backs of NVIDIA's trending, but over the last 2 days, it's on the backs of Taiwan Semiconductors guidance. And so we're rinsing and repeating it, the 23 conversation, but this time we're doing it on Taiwan Semiconductors, very mediocre bump up in guidance versus Nvidia's last year of just absolutely one of the best guidance reports I've ever read in my life. And so I have a little bit of concern on the legs that can happen here and the momentum that can happen here if it's not going to be broadly based. Because we have not even gotten into the heart of earnings season, Mark. We haven't even gotten into the Teslas and the Netflixes and the Apples and the Googles of the world. We've only been dealing with finance and a little bit of components out of each space, but it's really been finance. And when you talk about the ability for this market to break the all-time high and run, I just kind of feel like we're putting the cart before the horse a little bit right now, when the market has not gotten that confirmation yet from an earnings perspective, specifically in my estimation. Thoughts?
Yeah, no. When I woke up on Thursday morning and saw the thing, I thought we might have had one of those guidance earnings reports that was like, oh, they must have just smashed it. And then when I heard your analysis, I was like, yeah, I was with you. The market wanted a reason to run one way or another, and Friday felt just like a continuation of that. Matt, it's going to be really hard for me to get excited about this breakout unless you have something. Stellar earnings across the board, a falling dollar, supportive monetary. I don't got any of that.
Let me take those three.
Yeah,
okay?
Okay.
Let me take those three. So the first one was
earnings, just like, oh my gosh, something deserving a multiple increase, right?
This is the worst start to earnings since the second quarter of 2020.
All right, you're gonna have to break this down further. Like because once again, I'm prone to hyperbole. I'm allowed to say these kind of things. If you say them, then
I say it because that's what the numbers suggest.
Give us the numbers.
That's my opinion. When you look at earnings from a numbers perspective, you currently have 62% of companies beating the EPS handle.
That's a bad number.
I cannot describe how terrible of a number that is.
Holy cow, I didn't realize that until you literally.
One of the worst. Well, Mark, when you're dealing with mostly banks so far, the banks are beating the EPS expectation by a whopping 33% right now. 33% of banks are beating low bar expectations.
And Matt, the bar is extremely low
Twice
right
as
now.
low as normal right now. And it was that way last quarter as well. So expectations were very low last quarter. Expectations are very low this quarter as well. But you have 33% of finance companies. You know, when you have three components report and one of the three beats, you got 33% right. It's not a big deal because it's just three components. Mark, we're done with the capital markets. We're done with many of the regional banks. We're done with the big money center banks. We're done with the asset management banks. We're done with the financial space outside of credit card companies and insurance companies. And so it's not like this is a small scale from the amount of stocks we're looking at right now. You're talking about a majority of the financial space, and it's coming in at 33% beat against EPS. The market right now is at 62%. Just to give you a little bit of historical average, the 5-year average is 77% beat. The 10-year average is 74. I can't remember the last time I reported on a quarter that was in the 60s. And just to give you a comparison, over the last 2 quarters, Mark, the banks have beat like at 82 and 93% beat rate. This quarter, they're coming in at 33%. Revenue right now coming in at 62% beat as well. It's not abnormal for revenue to beat in the 62, 63, 64, 65%. But again, you're talking about a really weak start to the earnings season so far from just a raw number EPS versus revenue perspective. When you're looking at forward guidance, we haven't really gotten a lot out of guidance so far, and it's still early. Only 10% of companies have reported earnings so far. And so we haven't really got a lot from a guidance perspective. You got 5 companies downgrading guidance. You got 3 companies upgrading guidance, which is about on par for the 5 and the 10-year average from a guidance perspective. The valuation, we're still dealing with slightly higher valuation. In fact, that has gotten a little bit worse as the market is going up and earnings are not supporting that market move as of yet. And again, key word phrase there, as of yet. We still got a long road to travel from an earnings season perspective. But as of right now, valuation is creeping a little bit higher because markets are going higher, but earnings is not going higher. And so valuation, which was a little bit of concern going into earnings, is still a slight concern a week and a half into earnings. And then the very important blended growth number from an EPS perspective that I track started off the earnings season right around 1.3 to 1.6. 1.6 positive was the end of last quarter. Started off 1.3% with a little bit of the earnings revisions between the ending of last quarter and the beginning of this quarter. So we started right around positive 1.3%. And remember, Mark, I said 2 weeks ago, for us to call this a good quarter, we need to get into the 4, 5, 6% range on blended growth. Right now, after 2 weeks, it went from 1.3% down to a negative 3% after the first week of the bank earnings. After last week, that number is now at negative 1.7%, Mark. We are in the wrong direction from a blended growth. And so do I expect improvement from here? Yes, I do. I expect improvement from here. But you could have said that same thing last week and we didn't get it. We got deterioration. And so when you started off the podcast saying, you know, I think the word of the day and the word of the week is a little bit confused. I think it's okay to say that right now. You got a lot of separation. You got a market breaking out, but it's only based on a few stocks out there. And you got an earnings landscape that is not supporting the price action right now. And so for me, looking at this breakout, I'm a technician first and foremost. But my confidence in this breakout against the backdrop of the market is not high. It's not high, not as of yet, because I just don't believe we've seen legitimate catalyst, whether you're talking economically or whether you're talking from an earnings perspective or whether you're talking monetary policy. You had 3 points that you listed. I was just talking about the earnings one up front. I'm not seeing those catalysts as of yet that would spark the confidence in this breakout. And so I'm a little bit concerned about the veracity of this breakout. I think the market probably got a little bit too aggressive on Friday, and it's going to have to get dialed in this week.
Yeah. All right. So we don't have breadth, right, in this early year. We don't have earnings supportive of the breakout and higher multiples.
Not yet.
Well,
Not yet.
not yet. One of the things that also can support higher multiples, according to the classic Wall Street playbook, is monetary policy, right? Well, we have a Fed that is out there pushing back hard. Now, you and I have both, and we talked about this last week. We talked about this in the prediction podcast, that the market is dead wrong in, and made no bones about it last week, make dead wrong about 7 freaking rate cuts this year. Now, Bosky came out this week, and Waller came out this week, and some of the people that helped spur they're like, listen, they were like, maybe third quarter. You're not cutting 7 times if your first cut is in the third quarter, Matt.
Not unless there's an economic event, and those things we cannot predict. So
you don't even have, right, and the market is being stubborn. Where does the market stand at the end of the week, Matt? Because the economic data hasn't been too shabby, and certainly not freaking supportive of 7 rate cuts this year.
No, and I think that's what we're seeing play out here, Mark, is based on everything the Fed has been stating, but not just the Fed. You got the Bank of England, you got the Bank of the ECB, the European Central Bank, all pushing back against these rate cut expectations. It's almost like that all the leaders of the banks, the central bank, we call them the Max 7 in the market. We got to figure out a name for the central banks because they got 8 banks that we have to talk about, but it's almost like they got their marching orders from the Bank of International Settlements over the last couple of weeks saying,
we just call it the Bank of International Settlements, which is the coolest name. It is a Game of Thrones type name. It feels like there is.
Yeah, it's the BIS. And so the BIS gave their marching orders to all the.
Their acronym is actually BIS. Best in slot,
yes.
Which is a gaming term.
Yes. Bank of International Settlements, best in slot. Yes, it's BIS. And so, but again, they've all pushed back on this because over the last couple of weeks, Mark, you've had economic conditions that have not seen deterioration. You're going to get the advanced GDP report. It's going to come in at 2% here this week, and so. You haven't seen the economic conditions that would change the backdrop of this conversation. You have the central banks pushing back against rate cut expectations. You have most of the bankers in the U.S. pushing back against rate expectations because the market just, quite frankly, got out in front of its skis on this issue. To expect 7 to 8% or 7 to 8 cuts this year, I felt that was kind of outlandish coming into the year. And then you saw the first print of CPI report and you're like, bump up in inflation to start the year and you're going to get 7 to 8 cuts. Not going to happen. And so I do think one of the things that the market's doing over the last week, outside of the price action on Thursday and Friday, is it's coming back down to a little bit more of a normal conversation from a rate cut expectation. There was always the market was expected to start cutting in March. That has now came down to about 50-50, Mark. And I don't believe we're going to get a cut in March. I'm part of the 52.9%. But this is really kind of the first time you've had a majority of the marketplace not expect a cut in March. Up until this point, it was all cuts in March. So you've seen a little bit of pricing. For example, just 1 month ago, Mark, 71% of the market expected a cut in March. Today, that number is 46%. And so the Trading Justice podcast is doing its job in resetting the expectation of rate cuts that was completely false hope coming into the year. You saw that trickle down obviously throughout the year. And so you are seeing a little bit of expectations coming out of the market that you're going to get these aggressive cuts throughout the year. That expectation is getting reset a little bit. And for 2 reasons. Number one, You're dealing with a bump up inflation, not just in the US, but across the board from a global perspective. Number two, you got a lot of concern on the inflationary front with the Red Sea situation between the Houthi rebels, the US military, everything that's happening in the Middle East right now. You could see some elevated impacts of inflation due to the supply chain. And so that's a little bit of a concern right now. And then you got the Fed coming out and pushing back very hard against the market regarding these expectation on cuts, because like you said, Waller and Bostic today.
Well, and Christine Lagarde, she said something this week that she said kind of like the quiet part out loud, where she basically said, listen, you are making our job harder, because essentially if you keep partying and you keep having these expectations, the inflation's coming back and we have to do this all again. Like, you're making our job harder by doing this.
Well,
So,
and I would say that's specifically a comment towards Europe that can be loosely applied in the US, but they are slightly different situations. The US has a better situation economically and from an inflationary perspective than Europe does. And so I would rinse and repeat what Lagarde said. If I was Lagarde speaking about the Eurozone, that could impact the US, obviously, if you start to see commodities start to run, if you start to see the market run hard aggressively here. Mark, we're not talking about 2.5% CPI prints right now. We're talking about 4% CPI prints right now. And so you got a lot of work to do. And so I certainly respect what Lagarde said. I do think it's more relevant to what she's looking at within the Eurozone versus what we're looking at in America. But they can loosely be applied, I would say.
yeah, no. And so, all right. So, and this is one of those, like, when I was going through my thing, I was waiting to hear your earnings take, because, I'm not going to do that on a Saturday. I'm going to do all my other macro stuff on a Saturday, because I know I'm going to meet with you on a Sunday. But I knew that monetary policy wasn't supportive. I knew that we didn't have breadth on that breakout. I mean, you look at some charts, man, ARC is downright ugly. Small caps is sloppy. I go throughout commodities in general, and we'll talk about them in a second. They're sloppy. I got a lot of sloppy charts, and I got some ugly charts. I would say IWM, sloppy to start the week. Maybe it develops, right? Small caps, but it's sloppy. ARC, ugly. Small caps looks as much like a violent bearish retracement as it does something constructive to develop. And so I got a lot of slop out there. I don't have breadth. Earnings aren't great. Monetary policy doesn't feel like that can expand the multiples. So, yeah, shrug my shoulders, right? Shrug my shoulders and be like, I guess. And it's not even that, like, I have an NVIDIA type tech story, right?
No,
Like
you got a Taiwan Semiconductor that the market heard something that I didn't.
and so it's like, now it would not surprise me at all, Matt, to see the market party at the start of the week, right? Because, momentum begets momentum. We know this in trading. Momentum begets momentum, and then that momentum can beget more momentum.
Mm-hmm.
But man, when you look back at history, Matt, there have been some all-time high breakouts that did not end very well. Right? The euphoria is there, the last push, the last drunken vendor, and then there was nothing to propel it higher. What can change that from, like, earnings, right? Is that where we're at right now? Earnings?
It's the importance I put on earnings. And so to me, the only thing that can change this is either one, the breakout gets supported this week by the Teslas, the FCXs of the world, Netflix. The two big ones out there this week are Netflix and Tesla. They come out this week. They give good earnings reports. You can certainly build a little bit of confidence here. Confidence can come very quickly just from a couple reports, Mark. And so
it's true.
I don't want to come out and be like, oh man, fade this breakout. This breakout's a breakout on a multiple time.
No, that is a 2 week from now conversation.
Yeah. And so, if we are going to fade this breakout, it's not going to be on the day of the breakout. That's why confusion.
Especially
when a lot of us at Tackle are still waiting on NVIDIA to slow down at our price target at 600. So,
and I know in this radical world, if you are not euphoric, that means you're bearish because you have to take a side in everything, right? You're not allowed to say, I don't know, right?
oh,
I mean,
we'll say it. The market doesn't allow you to say that, but we'll say it. We don't care about that.
And so, certainly, so potentially earnings. Our next inflationary report, because
Well, you also got the Fed on tap here in a little bit as well.
like, what are they going to say? We haven't heard Powell speak. Like, we haven't heard Powell speak, Matt, and the Fed officials have been trying to. Why are they cutting?
Why are they cutting?
Yeah, because
you want to have that conversation.
Probably next week.
They're cutting because of the financing of U.S. debt. That's why they're cutting.
Because when you just look at the inflationary and economic data, it doesn't support cutting. I mean, it just doesn't at all, right? But
again, I don't think they are cutting in January, and I don't think they are cutting in March. That's what the market expects. That's not what I personally expect.
Yeah, you and I both have been on that. All right.
So I think the better question is not why are they cutting? Why does the market think they're cutting? And now the market is realizing that their expectation of cuts were probably a little bit false hope coming into 24.
What does this do to the dollar? Let's transition to the dollar, and I want to interweave
a couple final thoughts on earnings, just very, very quick.
Okay, absolutely.
Couple just final thoughts.
I was satisfied with they suck, so that was enough analysis for me.
I know you wanted to hear that. I'm just going to say it's very early in earnings season. We only have 10% of companies reporting, and we have not gotten into the major components yet. That's what I'm going to say. But
I wrote down they suck.
But that's true too so far with the 10% reporting. They have sucked. Yes, that is accurate. Mark, a couple themes have emerged very quickly from an earnings perspective. And this is something I think is going to be important to track throughout earnings season. Number one, the EPS misses is leading to a contraction in net profit margin. And so with the sizable misses on the EPS side of the equation, you are seeing net profit start to contract at lower levels that we have not really seen since the pandemic. And so net profit is contracting, net margin and net profit is contracting due to the EPS misses. I think if that continues, this breakout is going to have a little bit of a difficulty finding legs here. And on that earning EPS beat, Mark, when you're looking at the best sector and the worst sector from an EPS beat so far, finance is by far the worst sector. They are missing at a negative 36% rate. That's how bad the banks are right now. They are missing at a negative 36% against expectations. The best sector right now, consumer discretionary. They only have 4 components reporting so far. There's nothing to see here. They're at positive 13. And so the
mama and daddy were out putting a lot of money on their credit card this last quarter. So, I mean, we know that from the data. I'm not even joking.
That is true. That is true. But again, we have not seen the kickstart to earnings Mark, if we were at 90% beats on EPS and we were looking at this breakout right now, I'd be like, oh my goodness, let's party. Let's giddy up and go.
Oh, absolutely. Even me who does not put the emphasis you do on earnings, I'm like, that can carry a leg higher, a 2 legs higher,
but
right?
All the earnings data suggests we're looking at a weak start to earnings that has to improve. This is not an if A then B. It has to improve for this breakout to have some legs. And so and again, you look at the S&P, what we're really talking about here is technology and communications. That's what you're talking about when you're talking about the S&P 500 right now. You're talking about those 2 sectors. When you're looking across the board, we have not seen participation in the equal weighted index of the ES called RSP. We have not seen participation out of the ultra growth sectors yet, named ARC. We have not seen participation in the small and the mid cap indexes, the economically sensitive. We have seen massive participation in semiconductors, technology, software companies, communication companies, AI companies, And this is really, really eerily similar to what we went through in the first, I would say 9 of the first 10 months of last year. And so it's only a day and a half into that saga, Mark, but we're very familiar with that saga. We went through it a lot at the beginning of last year. I just don't believe that the rationality for this breakout and the causation following Taiwan Semiconductor is the same storyline that
that's such a key critic. That's probably the biggest drop here in this whole podcast, is that's not NVIDIA. That's not the same storyline.
Well, and honestly, Mark, NVIDIA was such an important stock to this conversation. NVIDIA had one of the better breakouts we've seen in a long time, that $500 breakout. It was on our scatter report. We talked about it just nonstop. Mark, I called this King's Bed pattern all the way back to 450 with the bounce off the 50-period moving average. Let me ask you a question. With the market breaking out today, NVIDIA is at our secondary target right now. And so for the market to have legs, you're asking the most important stock to the market right now is NVIDIA, and there is not a close second, Mark. The market is not, and I'm not just talking about this breakout in the market. I'm talking from an earnings perspective. If you remove NVIDIA from the blended growth right now, it has a bigger impact on the entire S&P 500 than even Amazon does. And Amazon's the biggest.
I didn't know that, actually.
Of them. If you remove NVIDIA, if I were to do this every quarter of the last 8 quarters, it was Amazon. If you remove Amazon from the blended growth number, it looks like this. Now it's NVIDIA. Right now, blended growth of negative 1.7%. If you remove NVIDIA from that equation, it's a negative 3.6% right now. And so it's the number one most important company to the marketplace. And I just have to openly question whether or not NVIDIA can run again, the most important company in the market, the leader of the market, the company everybody talks about. Are we really going to suggest it's going to rinse and repeat the last 2 weeks following perhaps the most pure breakout we had in the marketplace, and now it's just going to run on top of 600 again? Mark, I just don't believe that's going to be the case. When you look at NVIDIA in the last year, the best stock in the last year, Mark, it really only had these 2 candles last year once. It had a lot of continuation, a lot of fading, a lot of consistency, but it only had this massive momentum one time last year. And after that occurred, it started fading out. And so when we were looking at NVIDIA 2 weeks ago for this trademark, we were talking about an aggressive trigger above 505 with the price target of 550 to 600. We're now at 560.
Brother, you got it.
We're now at 565. Okay. And again, kudos to the tackle trading team on this one, because it was an amazing trade. And I hope a lot of people at tackle trading got a lot of love from that NVIDIA trade. But are we really going to suggest that NVIDIA is just going to run on top of 600? Because for the market to break out and continue, that's what you're asking.
Well, you're asking one of 2 things. Either you have tech carry you another leg, or you get broader participation.
Broader participation is not going to happen with the earnings results that we're seeing right now.
Yeah. All right. I love when you turn bear.
The earnings results we're seeing right now, we're seeing in IWM, we're seeing in the ARC, we're seeing the impact in the RSP, the S&P 500. You're looking at NVIDIA. That's what you're looking at. And so, and Taiwan Semiconductor. Taiwan Semiconductor needs a secondary pattern, certainly. NVIDIA needs, for me, I think this is a profit taking here on NVIDIA. I would look at the 600 zone, and don't get me wrong, I would recommend that you allow momentum to play out, that you aggressively start trailing stop losses, and you look to scale out of the position around 600. Well, Mark, that's $5 away from us on NVIDIA right now. That is literally 2 seconds in the trading day for NVIDIA. And so again, I guess my concern for the breakout on Friday in the marketplace, I have respect for the breakout. I always will, but I have some concerns based on a couple different things. Number one, the breakout is not widely supported from an earnings perspective. Number two, the leadership that has propelled this breakout is now getting fairly overextended. And I'm looking at you, NVIDIA. I know we all talked about Taiwan Semiconductor, but the market's not breaking out unless it's the momentum of NVIDIA here. You're now at T2 targets on NVIDIA. I could certainly see the traders start to lock in a little bit of profit and secondary patterns start to develop right around that 600 level. And so I feel this week going into this week is a really, really important secondary confirmation week against the backdrop of the breakout. If the breakout is legit, that's fantastic. We'll get multiple different trading scenarios there. But the problem is the breakout only has about 5% of the S&P supporting it right now. That needs to improve for me to have a lot more confidence in the breakout, because I have confidence in NVIDIA. I love Taiwan Semiconductor. These are two of my favorite stocks in the marketplace. I'm not going to talk bad about their companies, but I will look at them from a technical perspective and say NVIDIA is overextended, and the market took a company I know extremely well, Taiwan Semiconductor, and they took their earnings report and they took it a little bit further than I would have personally. And so I do think you need to see a little bit more confirmation coming into the market, or this breakout is going to be a fake out.
All right, so general cautious. What would change in this coming week, right? We take these time periods in a week-to-week basis that would make you less cautious. Be like, oh, all right, I'm getting on board. What could occur this week, or maybe raise some red flags this week to say, no, I'm not even slightly bullish. I'm just downright neutral right now.
Well, and again, I kind of mentioned secondary confirmation, and secondary confirmation from a technical perspective is an additional close above the breakout channel. That would certainly help from a technical perspective. Having the market, technically, if the market wants to play a little bit of defense above the breakout channel this week, I think that would be a really, really good step in the right direction. Kind of holding the breakout channel would give me personally a little bit more confidence from a technical perspective. Don't get me wrong. I love the technical breakout here. It's a beautiful backdrop for a breakout. I just don't believe that the fundamental conditions are supporting it as of yet. And so for me personally, having the market play a little bit of defense above the breakout channel, that would go a long way to help the confidence. Number two, when you look at the earnings landscape this week, Mark, again, I took Taiwan Semiconductors as a positive. I just didn't read Taiwan Semiconductor's earnings report and rinse and repeat like it was the first quarter of NVIDIA last year. That's what the market took. I didn't take it that positively. I took it as a good step in the right direction for Taiwan Semiconductor. The market heard something else. And so I personally would like to hear from some of these major components this week. If the market breakout's going to have legs, it's not just going to be on the backs of a lukewarm upgrade on revenue guidance out of Taiwan Semiconductor. It's going to have to be provided through some leadership in the market. And this week, from an earnings perspective, you have a lot of secondary companies that I find extremely compelling, like FCX, for example, Still Dynamics, Lockheed Martin, Raytheon.
Huge cross section of companies.
Yeah, really important names out there to the market, but none of the names are as big as Tesla. Tesla has a very low bar to overcome here from an earnings perspective. Let's see if they can provide a little bit of leadership. The polar opposite conversation on Tesla versus NVIDIA. You went from 260 down to 212 so far in the last month or so on Tesla. We'll see if they can change that around and start providing a little bit of leadership for the discretionary space specifically, maybe the market secondarily. And you also have Netflix, Mark, and people want to talk about the 23 market, and rightly so. We give a lot of credit to NVIDIA. We give a lot of credit to the Mag 7. We give a lot of credit to these areas of the market for carrying the market last year. But Mark, quietly, Netflix had a really good year last year. And it was Netflix early on, not NVIDIA, that kind of started the market trending even before NVIDIA. And so I would say Netflix this week takes on
It has been a pretty good barometer for several years, hasn't
it
it?
has. It has. In fact, again, I would say Netflix was one of the more important companies to the market last year, specifically on the earnings saga. Mark, for example, here's old Netflix just a quarter ago gapping up and providing a lot of leadership to communication. A lot of turnaround happened around Netflix's earnings report last quarter within the communication space. And so I would personally say Netflix is a little bit more important to this conversation than even Tesla is. But I would say that that's 1A, 1B, however you want to categorize that this week. And so from a technical perspective, I'd say the first thing I'd like to see is the market play a little bit of defense above the breakout channel. Earnings perspective, kind of building a little bit of confidence in this breakout. I'd like to see it supported a little bit more broadly than what we are seeing so far. We have not seen broad participation in this rally over the last 2 days, and we haven't seen broad participation from an earnings perspective. This is that week that we can see a little bit more broader participation. It's been a few companies. Last week we had like 20 companies. The week before we had 9 companies, most of them in the financial space. We start broadening out that conversation this week in earnings. And so I'd like to see that. I'd like to see the earnings conversation improve on the week where we start to see it get broadened out. And then when you look at it from not just the fundamental perspective through earnings or the technical perspective that we talked about, but when you look at it from an economic calendar perspective, Mark, last week we dealt with a little bit of economic reports. Obviously, last week you were dealing with, the World Economic Forum all week last week. You were dealing with a little bit of the Empire State Manufacturing Index. The two major reports last week were retail sales, which certainly came in better than anticipated. 0.6 on retail sales, expectation was 0.4. And then you had the University of Michigan Consumer Sentiment Report last week that also saw a sizable bump up in consumer sentiment in the marketplace as well. So the consumer is still strong in the market, but for this week we're looking at a pretty important week from an economic perspective. Advanced GDP, flash manufacturing and service PMI numbers, and core PCE price index. Mark, if we get through this week and we play defense above the breakout channel, earnings starts to see a little bit of an improvement. For example, can we at least get 1 week where we see the blended growth improve in this earnings season? Because in the first 2 weeks,
I would hope.
Okay,
but if it doesn't, what was the number? Minus 1.4 or something?
1.7 right now.
Yeah, better.
And then you got a pretty important economic leak. So one, let's see the breadth improve from an earnings perspective. Number two, let's see if the market can play a little bit of defense above the breakout channel. And then number three, let's see where we're at by the end of this week from an economic perspective. You get manufacturing and services, you get an inflationary index with the PCE price index, and then you get the advanced GDP report, which is expected to come in at 2%. This is the first report within GDP. It's going to be a fairly important one to kind of set the stage for the conversation. But Mark, most GDP numbers have become less important as the Atlanta Now GDP has become a little bit more of a leading indicator versus.
Holy cow! They just report the GDP ahead of time. They're so accurate.
Well, there's no surprise to us through the GDP reports anymore. I would say PCE price index the number one economic report, but I would put flash manufacturing and services PMI as the second one.
You listed three things there. I'll show a fourth, Matt. That I get some breadth anywhere, Matt. I'm not only not getting breadth in a lot of areas of stocks, I'm not getting breadth in commodities at all. We have either, I did the commodities report this weekend, Matt, and my conclusion in the video was I either got sloppy or crappy charts, and nor do I have sell-offs big enough where I can even play contrarian yet. I got a lot of slop out there, a lot of tough charts. I need to see some breadth. I need to see it cannot just be a few handful of companies, right? especially when it's not supported on catalyst. I mean, I gotta get something, right? Small caps, RSP,
Yeah, let's
I don't care what
let's
it
see
is.
RSP fight to the top of its resistance. Let's see IWM go through some or ARC and IWM go through some reversal analysis. That's how deeper their retracements are. But you're absolutely right. It's a sloppy start to the year, despite the fact that S&P is breaking out of all-time highs, despite the fact that there was a lot of ink spilled on Friday and Saturday talking about the S&P 500 at all-time highs. It's not a clean market right now. You got a lot of chop underneath the surface, and I have a tendency to believe that we'll work out that chop throughout earnings season.
Yeah, Matt, let's just talk briefly about crude oil and gold and Bitcoin, and then I want to spend a few minutes on the dollar.
Yeah.
Yeah.
Quickly, I can rapid fire gold very quickly. It's been a covered call environment. It's going to continue to be a covered call environment. This is not a pickup as of yet. Just a little bit of broad range neutrality right now on gold. You got support around 2K. You got overhead resistance at 2100. Honestly, until you start working through reversal analysis at 2K or lower, or until you start getting back up into the 2100 level and you're talking a breakout, you're talking some degree of covered call environment. So it's not exactly the sexiest conversation on gold right now. I believe in the fundamental backdrop of gold. I believe every portfolio should have a certain percentage dedicated towards gold. But in terms of the short-term technical scenarios where you're looking at, ooh, this is an add point. No, we're not there yet. We're still in a choppy covered call environment.
Yeah, I know. And crude oil has, and I talked about this in the commodity report for pro members, one of the more fascinating moving average patterns on multiple time frames. Matt, is the type of pattern, and I encourage pro members just to, even if you don't normally look at the commodity report, go spend the first few minutes of the video. There's no way to explain price action other than moving averages on that chart, right? Like where you have things acting against support and you create this narrow range. It's just a beautiful technical story. But eventually, Matt, you're going to have to make a move. You can't stay there forever. I have higher oil prices. What's the situation? And I'm curious to your take in the Red Sea, the escalation. I saw more headlines this weekend. Oil hasn't reacted. Gold hasn't reacted. Really, nothing's really reacted. But people are starting to chatter about supply chain problems coming out of that. Is that something real? Is that something we should keep our
discussed
eye
it
on?
last week. We discussed it a little bit in the halftime report this week, and yeah, it is a concern. The supply chain situation through the Red Sea, it 100% is a concern right now. And no international organization should allow the Houthi rebels to be able to take pot shots on shipping containers in the Red Sea trying to get to their destination. So I fully support America to do whatever they need to do to make sure those shipping containers are safe as they traverse throughout the Red Sea and the Suez Canal, and hopefully the U.S. military can put their might down and stave off an expansion of that war. But as of right now, that's what we've been dealing with for the last 2 weeks.
I mean, is it a market story yet?
It is. Yeah, I do believe it is a relevant market story, but it's still in the same vein of thought of the expansion of the war within the Middle East itself. And so I do think you have some concern on the oil side of the equation, but a shot every now and then. I mean, we're talking about oil and the number one commodity that is traded throughout the entire world. So a couple shipping containers here and there, it's not going to have a major impact. But if it doesn't stop, it could be growing into a major situation. And so the last 2 weeks, you've just had it going back and forth. There's not been a real change in the status there. The Houthi rebels out of Yemen, they keep taking shots in the Red Sea, and the U.S. military keeps dropping bombs.
Yeah, and it's one of those things so subtle because like its impact on inflation, it's not one of those, it's one of those things that would like influence over time if it's not resolved.
Well,
There's not like a clean metric like, oh, this is, like it's
number one thing people need to realize about inflation is it doesn't work fast.
Yeah, it's so gradual, right?
People, like, it drives me. I think it's the number one thing that drives me most crazy about people's interpretation of economic scenarios is their understanding of the speed of inflation. Inflation does not happen overnight. It does not happen in a singular moment in time. It is a slow, methodical beast that gets built over time. A proper analogy would be a snowball rolling down a mountain. It starts small and it picks up over time. And so, like, for example, the Houthi rebels hitting a shipping container in the Middle East has zero impact of inflation in that singular moment in time. Zero, none. It doesn't even, you can't even recognize it. It doesn't have an impact. The things that were happening 4, 5, 6 years ago still has an impact on us today from an inflationary perspective, because inflation is a lot about the money supply. And the money supply takes a tremendous amount of utilization before it gets worked out throughout the entire economic system to the point where it becomes valueless. And so inflation takes a very long time to build, and it takes a very long time to kill. It is not a swing trade. It's not a position trade. These are part of market cycle conversations, not a singular moment in time.
Yeah, no, it's such an excellent point. Such an excellent point. And then I still don't have my options on IBIT, Matt.
You'll get them.
I want my Bitcoin. I haven't cash flowed in a month.
I think
I'm starting to
like
get a sell-off.
in inflows.
Like, I'm starting to get a sell-off in Bitcoin, and I can't even go look to see what I'm getting at low delta naked puts.
Well, would you agree that the two ETFs in the Bitcoin world that are becoming a little bit more dominant in the conversation is GBTC, because of their leadership that they had coming into it as a trust, and IBIT? Is that?
Yeah, I mean, I think this debate, I've always thought this debate would be settled really quick, and the volume, not the option volume. That was speaking out of like some Freudian want desire.
Oh yeah, that was complete desire.
But the volume is supportive. I mean, this was not a fun call. I mean, these are going to be the winners, right? The interesting thing, Will, is can one beat the other, right? Can one beat,
GPTC just has such a head start from I think they had like $25 billion in inflows, but they've also been a trust for years. IBIT's a relatively new product, obviously. I don't know. I think they're both going to have quality, a lot of volume. I think there's going to be plenty of volume to trade either one, in my estimation. IBIT, I'm a little bit surprised that these ETFs don't have options yet.
I'm totally shocked. Like totally shocked.
I thought they would have them in the first week, but they're not. They'll come. I wouldn't worry about it too much, but they'll come. But Mark, they'll come right in time for us to get a reversal here.
Dude, that would be nice.
Yeah, that would be nice.
And then I can complain that Delta traders are beating me on, but I'm making money. But
what's your is it still sell the buy the rumor, sell the news event? Are we still?
Well, yeah. I mean, and I think that's occurred, right? I think we are in the process of the sell the rumor part of it, and now it is just a question of, all right, let the volatility play out, right? Because I mean, once momentum and volatility starts, whether it is S&P to the top side or Bitcoin showing some weakness, you let it play out before you do anything too aggressive, right?
Two things have to occur for me on GPTC or IBIT. Number one, the technicals have to support the analysis. That has to occur. This is a technical saga for me moving into the future. And number two, you have to have options. They have to have tradable options on them.
You just do. You just do. Now, Matt, so much of the analysis in this show has been on, all right, caution, this, that, but it's still, our conclusion is still theta friendly, lean, bullish, right? I mean, we can scoff, we can question, we can this, but that's our ultimate. Now, Matt, if the dollar starts taking off, that's going to change for both of us just on that macro aspect alone, isn't it?
Yeah, you asked me what would need to change for me to get a little bit more.
And I've been trying to lead the whole show into this particular point.
I was holding on. Uh,
Yeah.
I was holding off a little bit because I knew we were getting into that, but I do think the number one concern that I personally have is earnings. I have a lot of concern over the weak start to earnings, and that can be a.
But is that more from a top side? How much can it go, or that could lead to a lay down type concern?
No, I don't have concern as of the downside yet. Like I don't have that concern.
So it's more what there's
It's
nothing
more
here
about
yet to
the
propel.
breakout. It's more about the confidence in the breakout than if eventually it turns. Because if eventually it turns, I do believe we'll see that technically as much as we would from an earnings perspective, even if earnings were to be the catalyst there. But if there's one thing that is a close second to my concern against the breakout in the market, it's my belief that the dollar and the market cannot trade. They can trade with one another, they can go with one another in the short term, but they can't trend aggressively with one another. It's very difficult when you're having rate sensitive conversations for the dollar and thus yields, because they kind of go in the same river downhill together. So dollar and yields to trend with the market trending. That is a really difficult thing for me to see the consistency of. Yes, can they move together in an algorithm move? Yes, but can they consistently trend together? My answer to that is typically a no. And so,
and you have said that for years and years and years. Like they're not going to. And Matt, you told me to go do some homework this weekend. You're like, go look at the last 15 years of the dollar and the S&P and see how the S&P does when the dollars trend. And Matt, and what you just said is so accurate. Can they trend together for a day, for a week, heck, even a month? Yeah, they can. They can both go in the same direction.
when you're not having a rate sensitive conversation, they can.
But if it gets too much, equities have a real hard time.
If you're not in the conversation of is the Fed going to do something or is the Fed going to do nothing? If you're not having that conversation and the economy improves, the market and the dollar will trend together. But if the Fed is involved in this conversation and we're having a rate sensitive conversation, it is really difficult for the market and the dollar to trend together.
And so, at the start of the year, when you look at the dollar and yields, which both have had a good start to the year from that perspective, like the price action everywhere else kind of makes sense to me, Matt. We've seen the dollar and
breakout. Yes.
We've seen the dollar and the yields go up, and we've seen commodities, meh. We've seen small caps, meh. We've seen your average stock, meh. Like there has been a lot of correlation between ugliness on a lot of charts and yields in the dollar going up. Now, the broad markets, because of their specific weighting to a few names, and they've been holding up, masking some of that correlation. And so, Matt,
just look at it technically very quickly.
Of course. Let's do it.
So the dollar right here, this is what Coach Mark's talking about. And if you're listening to this on the audio, I'm just looking at the retracements on the charts here on the dollar versus the S&P versus the RSP versus the IWM. So here's the weekly chart. You're looking at a nice little retracement on the dollar to start the year. Bearish retracement on the dollar on the weekly chart. Well, you come over to the Russell 2000, for example, RTY, IWM, however you want to categorize it. Well, what do you see? The polar opposite. You're seeing a pullback occur, right? You're seeing a bullish retracement on the weekly chart on RTY. You're seeing a bearish retracement on the weekly chart on DXY. You come over to, when you look at the ARK, ARKK. When you look at the ARK ETF, what are you seeing on the ARK ETF? You're seeing a bullish retracement on the weekly chart to start the year, very similar to what you're seeing on IWM. When you look at RSP, the equal weighted ETF, looking at the major market, what are we seeing? We're seeing a bull flag based pattern on the weekly chart to start the year. We're seeing a bearish retracement on the dollar. And so what I would suggest, Mark, is when you're looking at 93% of the market, the dollar is still having its typical impact.
Yeah, it makes perfect sense, right?
That it's having. It's the only thing it's not having an impact on is Nvidia, AMD, Taiwan Semiconductor, technology stocks, Meta, Google. It's really, it's still very similar, Mark. It's just not impacted. It's not looking like that when you're looking at the ES and you're looking at a breakout on the ES. But even the very first of the year was looking fairly similar. It's really only this week that is seeing the ES separate from everything else out there. But I would still suggest that the dollar is still playing the same role it always plays against the market right now.
And so that dollar correlation, Matt, and you and I both categorize ourselves as top-down analysts, right? Where we look at bigger things and then have that influence our decisions on the way down. Now, this breakout is also going to have a hard time if that chart right there starts climbing more, isn't it?
1000%. When you're looking at the dollar here, just from a multiple time frame perspective, on the daily chart, you have the dollar going through a head and shoulders formation. You got the left shoulder that was really kind of mid-December. Late December was the head, and then the right shoulder was kind of the first of this year. Earlier this week on Tuesday, you saw the dollar break out of that head and shoulders formation, and now it's high basing right around the 200 daily moving average. If this was a stock, we would all be looking at a potential reversal here. Would you agree with that?
Yes. I would be, especially because
on the reversal.
Because not just technically, Matt, from a cash flow perspective, but because it aligns with my macro view.
Yeah.
Right. Stronger economy in an election year. Fed that the market has gotten wrong. Not going to have that. That macro view is supportive of an intermediate higher dollar level. And then when you couple it with the technical, well, it's go time, right? Now it's go time.
So you got a reversal happening on the daily chart. You got a high base happening against the 200 daily right now. On the weekly chart, you got this as a bearish retracement that is coming into the last zone here. What I would suggest, Mark, is on DXY, if you see the market break above, if this market is going to have legs on the breakout.
Yes. Which is essentially the question on this podcast. We might as well label it that.
It's an extremely important question right now.
It is the question.
If the S&P has legs on the breakout, IWM's going to reverse. RSP is going to break out and get carried. And most of the market's going to be lifted. If
commodities at a minimum are going to do nothing and maybe even have upward price, right? Like,
yes, but if that is going to occur, it's not going to be based on a breakout of the dollar. And so if you're looking at the dollar here, the dollar, number one thing we want to see this week is the dollar to come back down. That is the number one thing we would like to see this week, is for the dollar to dirty up this joint and start retracing to back down and give up some of the strength that it has had at the very beginning of the year. That's an if A then B scenario. Right now it is showing strength.
Because that is another thing in your homework assignment to me, Matt, is that during periods where the dollar does nothing, equities can have great times. They don't need a falling dollar to party. They just need the dollar to not be a story.
Trending dollar. The dollar can even slightly go up. It just cannot go in a strong trend. And to give you an example of that, we don't, and
you don't have to look back very far in history.
But to have an example of that, you can just go back to July, August, September, and October of this past year. What was happening going into those environments in the marketplace? Well, when you're looking at the marketplace going into those environments, Mark, well, the market was going down, 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 down. In fact, it was one of the worst environments throughout all of last year. Was August, September, and October, when we were dealing with that choppy, bearish downtrend in the market before the parabolic V-shaped recovery on the Fed pivot of November all the way through December. What was happening there? Well, what was happening to the dollar in that environment of August, mid-July, August, September, October? Well, all of a sudden it had the best trend it's had throughout the entire year. And so I don't think it's too shocking to suggest that if the dollar trends here, it's going to put a little bit of pressure on the S&P 500 because it just did that just this past little bit. But Mark, you found a couple other time frames that were a little bit important here as well. What were some of the other time frames that you were looking at that to give a little bit more emphasis on this dollar right now?
Well, when I looked at, because I was like, I'm, in typical fashion when we talked about this, I was like, look back at the last million years, and I was like, no, just go look back since basically the Fed took over the markets. He didn't use that language. But that's essentially what he said.
I said you don't need to go to the 80s on this one because it's not the same conversation.
It's like
one, but it really adopted post 08 in the US.
And during strong trends that last months, equities have one of two general outcomes. They have basically neutral to slightly bullish, or you have real volatility and nastiness. Classic example of that was 2022, right? Where one can say, why did the market have such a terrible year? Go look at the dollar chart, go look at the dollar chart. But that doesn't mean that's always the outcome. Like 2014, we had a similar, really strong dollar chart. Now, equities didn't party in that environment in the back half of 2014 and the start of 2015. They fought, but they didn't do much either, right? They kind of just ground ahead. And so, I mean, there's
last of 2014 and the entirety of 2015, I would say, was the worst year in the market for the decade of 2010 through 2020. People don't understand the chop that 2015 had. They don't. The 2015 had multiple environments with the S&P down 15 to 18%.
Yeah, no, it was
down. It ended up down 1%. Mind you, I'll remember the 2015 year my entire life because my prediction for that year was negative 1%, and it came in at negative 1%.
And the reason 2015 it was easy for me, even though there were moments of like, oh my gosh, is this going to give up? Because the reversals were so fast. Like you'd go down and then you'd have these really quick reversals back up, and it would like, okay, let me get rid of some stuff and feel better about things, right? And, whereas 2022 just seemed to last.
Are they not going to do quantitative easing this month?
It's like, and so, but like you cannot, and if all you do for about a 4 or 5 hour block is look at correlations in the last 15 to 16 years between strong dollar movement and stocks and just study the patterns, you can't walk away and be like, oh, there's obviously a correlation here, right? One that we understand makes sense from a logical perspective. There should be a correlation there, shouldn't there, Matt?
The dollar's the number one asset class in the world. Yeah, there's correlation everywhere. My number one concern on the breakout in the market is the dollar. And again, you're at a point on the dollar that if you break the 200-day moving average here and you break that 104.5 level, you enter into some open air. That's the concern. The concern is not a choppy head and shoulders formation at the bottom end of the chart. The concern is if the dollar trends back up into 107. That's the concern. And if the dollar trends back up into 107, we're not talking about a breakout in the marketplace. It's just not going to happen. The market's going to come right back down.
No, we're going to be talking about a fake out in the marketplace.
Exactly. And that's why I think the dollar conversation is really important right now, is because, again, you can go to 2014, 2015 and point to the strong dollar moves. You can go to 2008 and point to the strong dollar moves. But the simple reality is the dollar will put a tremendous amount of pressure on so many asset classes from a bullish v bearish perspective that the market will just have a very difficult time climbing. And as you start to climb more and more and more, what happens is you start to have earnings revisions start to go down, Mark, because as the dollar starts to trend, half of the S&P 500 companies' revenues come from Europe. Well, if the dollar is going to trend up and the euro is going to trend down, that means Europeans cannot buy as many of our goods, which means you'll deal with larger than expected earnings revisions to the downside as well. And so you got a lot of concern right now. And so to come back to
I mean, that's a nasty 1-2 punch, Matt, of earnings already. If they came in shake, you're right, 10%. I mean, this story is not done yet.
oh
right?
man, no, it's very early, but if
that's where we ended and then we have a strong dollar, that's a bad 1-2 punch, bro.
Listen, if we ended at these raw numbers where we started earnings season with, you have a tendency to like it when I get bearish. When I
just think it's fun, like, you know.
I have a little bit of a permeable heart.
Well, yeah, because and I have a little. The world is about to end at all times.
No. I believe that too. I just believe that the mechanics of the market are built for the bulls.
Yes, they are.
Yeah. So don't get me wrong. I believe in a little bit of that too, but I just have some concern, Mark. And so,
well, and that's a practical tactic. I mean, that is just downright practical. It's like, all right, we get a breakout, but if it's not supported by earnings and then we get a rising dollar, that is a nasty macro combination that lines up.
Mike Tyson 1-2 punch that will send the market back down. Yes.
You know,
and so I think I wanted to spend this podcast talking about some of the concerns that we have on the breakout, because if the breakout's going to have some legs, these concerns are going to get resolved, not in the long term, but in the short term. It's not in the long term if the dollar breaks the 200-day moving average. It's this week. It's not in the long term if Tesla or Netflix report to start giving us a little bit of excitement around the earnings conversation. That's this week. It's not in the long term that we're going to see these situations resolved. It's going to be this week and the week after that is going to resolve these open questions. And so if the dollar is going to trend here, I'm sorry, it doesn't matter what happens on earnings. It doesn't matter what happens on anything. The market is going to come back down. And so with the market breaking out, and
some stocks are going to get downright ugly that are already in trends that are go or don't go. Small caps comes to mind as symbolic of.
Again, I don't want to throw too much cold and too much rain on the breakout. As a technician, I respect the breakout, but as a top-down analyst, that breakout needs wider participation.
How does it feel to be so conflicted? Because the technician in you is like, that is so gorgeous, and the macro analyst in you is like, oh, there's some reasons to be worried here.
It's
how are you resolving that?
I'm a very confused individual right now. Again, the problem is not the breakout of the marketplace. The breakout of the market is beautiful. The problem is all the macro numbers don't support a breakout in the market as of right now. And so I feel like we're getting a little bit in front of some major news coming into the market in the next 2 weeks. And for me, I just felt like it was good. It was a much better backdrop to break out after Netflix and Tesla week or Apple and Google week than it was Taiwan Semiconductor week, which is more regional banks and healthcare companies. And so I just had a little bit of concern that the market read something into Taiwan Semiconductor that I didn't. I have a little bit concerned that the areas of the market that are trending very aggressively are now very overextended, such as NVIDIA. $600 was a price target for us for a reason, and now you're kind of coming into that zone. And so you're going to need to see something else occur, and that something else is either going to be, number one, earnings conversation this week that improves the backdrop. And if that earnings improves the backdrop, I'm going to have a little bit more confidence on that breakout, Mark. because that will improve the breadth of the market more than anything.
It will improve the breadth of the market.
Yeah. And so right now
but only if the dollar also doesn't show breakout signs itself, right?
Yeah, so you're running into some really important zones technically here on areas of the market that are not named the S&P 500, i.e. the dollar. You're coming into a major earnings week. And again, it's one of those situations, Mark, where if RSP was breaking out with the S&P, I wouldn't have as much concern on the breadth. Obviously, I wouldn't have as much concern on the earnings front. I have concern because this is not widely participated, and the earnings support it not being widely participated, which means the earnings actually supports the price action in ARC and IWM far more than it supports the price action in the ES right now. And that concerns me. And that concern leads, you can call it concern, you can call it confusion, you could say, I need to see more data, however you want to categorize it. I just feel like the market needs to see a little bit more data before people like me get a little bit more excited about this breakout.
Yeah, no, well said. This has been a really helpful podcast for me as I'm a professional. This is what I do for a living. This is, the analyst, the trading, everything. And it's been very helpful and constructive, honestly, being able to converse with you about this little inflection point, right? It feels like we're in an inflection point. Now inflection points can resolve one way or another, right? And it's been helpful in me in formulating my own thoughts. So
listen, we could easily came into this podcast and just geeked out for an hour straight on the breakout and the strength of NVIDIA and the strength of Taiwan Semiconductor. But I think we have a responsibility to talk openly about some of the issues that the market is faced with right now. And it's not an easy backdrop for the marketplace. It is not. You're going through earnings season. That's always going to be a little bit more volatile. You're going through a rate conversation where the market has to reset their rate expectations. That's never going to be an easy conversation for the market to have in the short term. And you're having an economic conversation on the will we or will we not recession with GDP on tap this week. And so there's a lot of information coming into the market right now. Stay with us every single day on the Tackle Trading Halftime Report as we will break it down every single day, both the news as well as the price action on our Tackle Trading Halftime Report.
Those sound like some good final thoughts, Matt. Anything else you want to pitch before we close out?
Got the new, if you are looking for a class from an education perspective, we got the next edition of the Option Success Training happening on the 29th and 30th of this month. And so right in about 8-9 days from today, we're going to be teaching the next edition of the Option Success Training. If you're a pro member, you will get an email tomorrow or today to sign up for that class if you want to sign up for it. If you are not a pro member, to get access to that class, you just got to sign up as a pro member and then email us at team@Tackle Trading and we'll get you registered for the upcoming class, the Option Success Training. And in that training, it's a 2-day class, 5 hours of education. It also has an on-demand that you go through at your own self-pace. Night 1, we're going to be talking about technical analysis. And in night 2, we're going to be teaching the basics of options. So if you're looking for a home, a community to call home, go over there to tackletrading.com. You can sign up for a free 15-day trial. And then if you're looking to get into a course to learn how to do this the right way, come sign up for the Option Success Training, which is January 29th and 30th, 6 p.m. Eastern Standard Time, 2.5 hours per night.
Well, everyone have a fantastic week. We'll be back with 563 next week.